Nvidia had a great year, dominating the AI chip market with a total stake of over 90%, which resulted in Nvidia becoming the world's first company to reach a $5 trillion market cap and currently sitting at around $4.5 trillion. Their most advanced Blackwell chips are effectively sold out with surging demand, but tides are turning slowly under the surface and Nvidia's dominance is under attack. I'm SK and today we are going to look at 3 major warning signs that every investor needs to pay attention to before it's too late. First up is geopolitical worries. As of January 2026, Nvidia's geopolitical worries remain dominated by escalating US-China tensions in the AI chip sector, with recent developments increasing market volatility and long-term risks. The company's stock dropped over 4% on Jan 20th amid broader uncertainties, including Trump's aggressive push for US control over Greenland's mineral resources, which could disrupt global supply chains for rare earth minerals, essential to semiconductors. Let's see 3 different ways geopolitical worries can hurt Nvidia. Number 1, US-China chip export. On January 13th, the Trump administration eased restrictions, allowing Nvidia to export H200 AI chips to China, with conditions like a 25% federal surcharge and mandatory US security screening. However, Chinese customs agents have blocked imports, advising state-linked firms to avoid them except in special circumstances. This retaliatory move follows Beijing's push for silicon sovereignty, mandating domestic chip procurement ratios. Nvidia's China market share is projected to plummet from 66% to 8% this year due to these conditions and local competition. CEO Jensen Huang has criticized the policies as a failure. Number 2, China's domestic alternatives. US bans are increasing demands for Chinese rivals like Huawei, Cambricon, which is planning to triple output to 500,000 units, and more threads, now meeting approximately 80% of total domestic demand. Chinese AI developers report a widening hardware gap, resorting to workarounds like renting compute abroad. But this accelerates self-reliance and fragments global ecosystems. Number 3, broader AI geopolitics. The Trump administration's national security strategy emphasizes exporting US AI tech to maintain dominance. But ongoing chip wars risk turning Nvidia into a geopolitical proxy. Suppliers have halted H200 production amid blocked shipments from China, adding supply chain strains. European trade tensions and potential tariffs threatens Nvidia's global dominance. Approximately 53% of Nvidia's fiscal year 2025 revenue was generated outside of US. If trade tensions and tariff wars continue and China achieves full independence, Nvidia's global market share will be severely affected. Moving on to second warning sign, which is the growing competition. As of January 2026, Nvidia's competitive landscape has intensified significantly, driven by the explosive growth of AI and the high stakes in data center infrastructure. While Nvidia maintains a dominant position, commanding over 80 to 90% market share in AI accelerators with its Hopper, Blackwell, and upcoming rooming architectures, the rise of custom silicon from hyperscalers, aggressive pushes from traditional rivals, and localized alternatives in restricted markets like China are chipping away its majority stake. Analysts highlight margin compression as a key risk, with Nvidia's gross margins potentially dipping from historic highs of 75 to 80% as alternatives scale and pricing pressures mount. There are 4 different categories of competitors that are coming after Nvidia's dominance. Number 1 is custom silicon from hyperscalers, the biggest internal threat. Nvidia's largest customers, Google, Amazon, Microsoft, and Meta, are developing in-house chips optimized for their specific AI workloads, potentially reducing reliance on Nvidia's GPUs. This internal competition could capture 10 to 15% of workloads currently handled by Nvidia, focusing on cost efficiency and energy savings rather than raw performance. There is Google TPUs, viewed as Nvidia's primary rival, with the latest Trillium 6th Gen TPUs offering superior efficiency for inference tasks. Reports indicate Google may lease TPUs to external parties like Meta, marking a shift from internal use only. If open source AI models proliferate, this could challenge Nvidia's ecosystem advantage. Amazon is producing millions of these ASICs, targeting cost-optimized training and inference. Microsoft's Maya and Meta's MTIA are scaling for internal clouds, with Microsoft potentially expanding beyond Azure. If AI demand concentrates among a few hyperscalers, custom chips could dominate, forcing Nvidia to lower prices or lose share. Nvidia's investment in some customers via financing are seen as artificially boosting the demand, raising sustainability concerns. Number 2 are traditional rivals who are gaining ground. Established semiconductor players are closing the gap in AI performance while undercutting on price, appealing to cost-sensitive buyers. AMD, which is Nvidia's most direct competitor, with the MI350X and upcoming MI440 GPUs shipping in early 2026. AMD holds 6 to 8% AI chip share, excelling in inference with lower pricing and better software. In consumer markets, AMD could capture share as Nvidia prioritizes AI over gaming CPUs. Then there's Intel, less than 1% AI share but improving with chips like Gaudi 3. Recent deal of $5 billion from Nvidia highlight collaboration amid competition. Broadcom is leading in ASICs for energy-efficient alternatives, gaining traction in data centers, have customers like OpenAI and hyperscalers like Google. These rivals are positioning as second sources to avoid Nvidia dependency, potentially compressing margins through price wars. Third are the China-specific competitors. US export controls have accelerated China's domestic chip industry, leading to a permanent erosion of Nvidia's presence from 95% to near zero market share in advanced AI chips. Projections indicate Nvidia's China share dropping to just 8% by year-end. Huawei is the dominant local alternative, covering around 80% of demand with efficiency-focused designs. Cambricon, Moore Threads, and others filling gaps in AI training and inference, supported by government push for silicon sovereignty. This has resulted in lost revenue, historically 20 to 25% from China, and potential global spillover if Chinese open-source models gain traction. Recent US easings on exports like the H200 may help AMD more than Nvidia due to retaliatory blocks. Number 4 are the emerging startups and niche players. Smaller innovators are targeting specialized AI segments, though they lack Nvidia's scale. Cerebras intensifies pressure with its wafer-scale engines, claiming 15 to 21 times faster inference and 32% lower cost than Nvidia's Blackwell GPUs. A landmark $10 billion OpenAI deal for 750 megawatts of compute announced in January 2026 validates this, accelerating LLM deployment and eroding Nvidia's dominance. Cerebras eyes a Q2 2026 IPO at $22 billion valuation, signaling sustained rivalry in energy-efficient, high-bandwidth AI tasks. Nvidia's strengths, including annual chip releases, CUDA's community of 5 million developers, and $500 billion in booked orders position it to weather these storms, with some analysts naming it a top 2026 pick. However, if competition scales and AI shifts towards inference or open source, Nvidia could face slower growth and valuation resets. We need to monitor earnings for signs of continued demand amid these pressures. Moving on to the final warning sign, chart technicals. As of Jan 20, Nvidia's stock is trading around $178. While the long-term uptrend remains intact, short-term charts show weakening momentum, potential reversals, and bearish signals that could pressure shares lower. These concerns stem from recent pullbacks after late 2025 highs, with the stock down 8% from January peaks. Analysts note sideways price action with risk of further downside if key support breaks. MACD and RSI are flashing sell signals. Recent MACD crossovers to the downside and RSI breaking below 50, currently at 45, indicate fading buy interest and potential overextension. Volume has declined on rallies, suggesting distribution rather than accumulation. The stock has broken the critical 50-day moving average price of $184, with risk of moving towards the 200-day moving average price of $150 if critical support at $170 is broken, potentially signaling a trend reversal. Failing to break $190 with a broadening top pattern, warning of extreme volatility and sharp downside if the upper ceiling of $195 isn't reclaimed soon. The stock seems to have entered a broader bearish channel, and it will probably stay within this channel for a few months until it reaches its deeper support level at $150, and then will probably continue its upward trajectory following the long-term uptrend. Despite these, people are relying on breakouts on Rubin and Blackwell increasing demands, with Q3 fiscal year 2026 earnings in February as a catalyst. Monitor for volume spikes above $190 to invalidate worries. Overall, it's been a wild ride in the AI arena. Geopolitically, the US-China chip wars are heating up, with export bans slashing Nvidia's market share and fueling Beijing's homegrown rivals like Huawei. Competition is no joke either. Hyperscalers like Google and Amazon are churning out custom silicon, while AMD and startups like Cerebras chip away at Nvidia's dominance with faster, cheaper alternatives. And technically, charts are flashing red. Fading momentum, broken supports, and bearish patterns hint at a potential pullback at $150 if conditions worsen. But Nvidia is still the king with Blackwell and Rubin on deck, and only time will tell what's actually going to happen in the AI race. Meanwhile, we can take precautionary measures by paying attention to the current conditions. Please let me know your predictions for Nvidia in the comments down below. Thanks for watching. I'll see you in the next video. Until then, take care and invest wisely.